Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Adobe Inc. Annual Report. Adobe Inc. offers a diverse range of products and services across three main segments: digital media, digital experience, and publishing and advertising. The digital media segment caters to various professionals and individuals, including photographers, video editors, graphic designers, game developers, content creators, students, marketers, business owners, knowledge workers, and consumers. This segment provides tools for creating, publishing, and promoting content. In the digital experience segment, Adobe offers an integrated platform that enables brands and businesses to create, manage, execute, measure, monetize, and optimize customer experiences. The target audience includes marketers, advertisers, agencies, publishers, merchandisers, merchants, web analysts, data scientists, developers, and executives across various industries. The publishing and advertising segment provides a range of solutions, including e-learning, technical document publishing, web conferencing, document and forms platform, web application development, printing, and Adobe advertising solutions. Additionally, the company offers consulting, training, customer management, technical support, and learning services to its customers. Adobe's products are licensed through app stores and its website, adobe.com, and marketed and distributed through various channels, including distributors, retailers, software developers, mobile app stores, systems integrators, independent software vendors, value-added resellers, and original equipment and hardware manufacturers. Adobe Inc.'s stock price plummeted by over 32% in the past year due to a combination of factors. One major concern is the intensifying competition from AI-powered creative tools and platforms, which has led investors to worry about Adobe's market share and pricing power. The company's own generative AI offerings, such as Firefly, have also raised questions about its ability to effectively monetize these investments. Analyst downgrades from prominent financial institutions further contributed to the stock's decline. Goldman Sachs, BMO Capital, Jefferies, KeyBank, and Oppenheimer all reduced their ratings on Adobe, citing increased competition from AI-enhanced alternatives in the creative market. These downgrades have eroded investor confidence in the company's future growth. Adobe's disappointing revenue guidance and outlook have also weighed heavily on its stock price. In December 2024, the company issued conservative revenue projections for fiscal year 2025, leading to a significant drop in shares. An underwhelming outlook in March 2025 further fueled investor anxieties about the company's sustainability. The broader economic and market environment has also played a role in Adobe's stock decline. Increased interest rates, inflationary pressures, and general economic uncertainty have led to a rotation away from high-multiple application software stocks, affecting Adobe despite its strong business fundamentals. Adobe Inc. market capitalization of $122 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Adobe Inc. holds a significant advantage in their industry. Adobe Inc. trades at a lower price-to-earnings ratio of 17 times, and a higher price-to-book ratio of 10.35 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 61% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be identified through a review of various company summaries. In the digital media sector, strong revenue growth is attributed to significant increases in the EMEA region. Conversely, publishing and advertising revenue has declined. Subscription-based services have emerged as a key driver of revenue growth across multiple industries. This includes cloud-hosted subscription services, on-premise software licenses, project-based consulting and training fees, maintenance and support offerings, and advertising revenue from transaction-based offerings. The importance of foreign currency-denominated revenue, treasury lock agreements, net gain/loss, reclassified from accumulated OCI into income, and depreciation and amortization expense of property and equipment also cannot be overstated. In the creative and marketing professionals sector, subscription revenue has grown significantly, while business professionals and consumers have experienced growth as well. However, a slight decline in 2024 is noted for both sectors. The cost of revenue, research and development, and sales and marketing expenses have all increased over the same period. Net income and profit margins. A changing landscape, the net income of a company underwent significant changes between fiscal years 2024 and 2025. On one hand, the net income increased by 28% to $7.13 billion in fiscal 2025 compared to fiscal 2024. This increase is also reflected in the data that shows an uptick from $9.5 billion in fiscal 2024 and a substantial jump from $4.4 billion in fiscal 2023. However, there are discrepancies in the reported net income change. The data indicates a decrease of $162 million from 2024 to 2025, which contradicts the initial statement of a 28% increase. Furthermore, an increase of $1,570 million is also mentioned, suggesting that the actual change may be more complex than initially stated. Profit margins also underwent changes during this period. The gross profit margin improved slightly, increasing from 89% in 2024 to 89.3% in 2025. On the other hand, the operating income margin decreased from 31.4% in 2024 to 36.7% in 2025, indicating a significant improvement. The reasons behind these changes are multifaceted. The improved profit margins can be attributed to higher net income growth rates compared to revenue growth rates. However, the decrease in operating income margin is likely due to increased sales and marketing expenses and interest expense. These factors highlight the complexities of financial performance and the need for a nuanced understanding of the underlying drivers of change. The company is generating positive operating cash flow, as evident from the consistently high net cash provided by operating activities. The figures for 2023, 2024, and 2025 are $7.3 billion, $8.1 billion, and $10.03 billion respectively, indicating a steady increase in operating cash flow over the years. This trend suggests that the company is able to generate sufficient cash from its core operations to meet its financial obligations and invest in growth initiatives. The company's debt level and interest expenses have undergone significant changes. An examination of the long-term debt reveals an increase from $5,628 million in 2024 to $6,210 million in 2025. This trend is consistent with the overall total debt outstanding, which rose from $5,650 million in 2024 to $6,150 million in 2025. The interest expenses have also seen a substantial rise, increasing by 56% from -$169 million in 2024 to -$263 million in 2025. This significant increase is further emphasized when comparing the change from 2023 to 2025, which shows an even more pronounced growth of 133%. These changes indicate that the company's financial situation has undergone a notable shift, with both debt levels and interest expenses experiencing substantial increases. The performance of various regions and segments has been a mixed bag for the company. On the positive side, Europe's EMEA region saw a significant 13% growth in fiscal 2025, while the Americas region also experienced a 10% growth during the same period. The digital media segment was another standout performer, with an impressive 11.5% year-over-year growth in ARR to $19.2 billion and 11% year-over-year growth in segment revenue to $17.65 billion. The creative and marketing professionals customer group also saw a notable 11% growth in fiscal 2025, while the business professionals and consumers customer group experienced an even higher 15% growth during the same period. These regions and segments have demonstrated strong performance and are likely to continue driving growth for the company. However, not all regions and segments fared as well. Europe's EMEA region was hindered by restrictive regulations for cross-border data transfers and data localization, while countries of concern such as China, Korea, and India struggled with developing privacy laws and regulations. These challenges have resulted in poor performance from these regions and segments. The APAC region also experienced moderate growth at 10% in fiscal 2025, which is lower compared to the Americas region, but still a respectable figure. The digital experience segment saw a 9% year-over-year growth in revenue to $5.86 billion, indicating a stable but not spectacular performance. Overall, while some regions and segments have excelled, others continue to face challenges that need to be addressed for sustained growth. Management is optimistic about the company's outlook, emphasizing its commitment to empowering customers through AI-driven solutions. The focus is on two key customer groups: business professionals and consumers and creative and marketing professionals. To achieve this, the company plans to develop a large partner ecosystem, expanding availability of solutions and prioritizing customer success. The demand for digital media and digital experience offerings is strong, driven by product innovation. Management highlights the importance of delivering value through AI-powered solutions that meet customer needs. This approach will be executed through audience-specific product innovation and go-to-market strategies tailored to each customer group. To drive continued business success, management plans to invest in research and development to remain competitive. The company will also focus on long-term opportunities in its end markets. Additionally, it will continue to make short-term and long-term investments, using cash reserves to repurchase stock and strategically acquire companies or technologies that complement the business. The company has been actively engaged in share buyback programs over the past year. One notable example is the total of 30.8 million shares that were repurchased during fiscal 2025. This significant purchase was made possible by a substantial payment of $11.06 billion for common stock repurchases. Furthermore, the company's commitment to buying back shares is evident in its payments, totaling $11.28 billion made during fiscal 2025. Concerns about inventory buildup and supply chain disruption exist due to the complexities of modern logistics. One key area of concern is the reliance on third-party distribution platforms. These platforms can be a double-edged sword. While they offer convenience and efficiency, they also introduce risks if not managed effectively. If partner or distribution channels are not functioning as intended, businesses may lose sales opportunities, customers, and revenue. This highlights the importance of carefully selecting and managing these partnerships to mitigate potential disruptions. That concludes the financial summary for Adobe Inc. Feel free to comment below, and I will be happy to answer them when possible.